Picture this. A 42-year-old software engineer in San Francisco just received his pink slip. His mortgage payment is due in 3 weeks, his savings account has been drained by inflation, and his stock portfolio has lost 30% of its value in the last 6 months. Sound familiar? It should, because right now, in early 2026, we're standing at the edge of something that economists have been whispering about in closed-door meetings for months. The warning signs are flashing red, the dominoes are positioned perfectly, and what's coming might make 2008 look like a dress rehearsal. But here's the twist that nobody's talking about. We're actually in a far more dangerous position than we were back then, and I'm going to show you exactly why. Let me take you back to September 2008. Lehman Brothers had just collapsed. People were lining up outside banks, desperate to withdraw their life savings. The housing market was in freefall. Retirement accounts were evaporating overnight. Your neighbor who worked in finance for 20 years suddenly couldn't find a job anywhere. It was chaos, it was devastating, and it reshaped an entire generation's relationship with money. But what if I told you that compared to what we're facing right now in 2026, that crisis had training wheels on it? What if the very mechanisms that saved us back then are the exact reasons we're more vulnerable today? The global debt situation right now is absolutely staggering, and I'm not talking about your credit card bill. We're looking at government debt levels that would have been considered science fiction in 2008. The United States alone is carrying over $35 trillion in national debt. Think about that number, $35 trillion. That's more than the entire GDP of the country. In 2008, we were at around $10 trillion, which seemed massive at the time. We've more than tripled our debt in less than 2 decades. And here's the kicker. Interest rates are no longer at zero. The Federal Reserve can't just drop rates to stimulate the economy because they've already played that card repeatedly. We're in uncharted territory, navigating economic waters that no generation before us has ever seen. I hope you're doing well, and before we go deeper into this financial rabbit hole, if you're finding this information valuable, please subscribe to my channel and hit the bell icon, so you don't miss the next video where I will break down exactly what you can do to protect yourself from what's coming. Your financial future might depend on the information we're sharing here, and I want to make sure you're prepared for every twist and turn ahead. Now, let us talk about the elephant in the room that everyone is trying to ignore, the commercial real estate apocalypse that's unfolding right in front of us. Since the pandemic fundamentally changed how we work, office buildings in major cities are sitting empty like ghost towns. We're not talking about a few vacant floors here and there. We're talking about occupancy rates in some cities hovering around 50% or lower. These massive skyscrapers that were once symbols of economic prosperity are now financial time bombs sitting on the balance sheets of regional banks across America. In 2008, it was residential mortgages that brought down the system. In 2026, it's commercial real estate loans that are starting to default at alarming rates. The banks holding these loans are the same institutions where millions of Americans keep their savings. The difference between now and 2008 is that back then, the problems were somewhat contained to specific sectors and specific instruments like mortgage-backed securities. Today, the problems are everywhere simultaneously. We've got geopolitical tensions that are disrupting global supply chains. We've got inflation that's been stubbornly persistent despite aggressive rate hikes. We've got a labor market that's showing cracks with tech layoffs reaching numbers we haven't seen since the dot-com bubble burst. We've got consumer debt at all-time highs with credit card balances and auto loans reaching levels that would have seemed impossible just 5 years ago. Every single pillar that holds up our economic system has fractures running through it. Here's something that should keep you up at night. The banking system today is actually more concentrated than it was before 2008. After that crisis, we were told that banks were too big to fail. So what did we do? We made them even bigger. The largest banks absorbed the failing ones, creating financial institutions so massive and so interconnected that if one stumbles, the entire global economy trembles. We learned nothing from history except how to make the same mistakes on a grander scale. Silicon Valley Bank collapsed in 2023, and it sent shockwaves through the entire financial system within hours, not days or weeks. That's how fragile everything really is beneath the surface of apparent stability. The stock market valuations right now are trading at levels that historically have preceded major corrections. We're seeing price-to-earnings ratios that suggest investors are pricing in absolute perfection for years to come. But look around. Does anything about our current situation suggest perfection? We've got artificial intelligence disrupting entire industries before we figured out how to retrain workers. We've got demographic shifts with aging populations in developed countries, creating massive pension fund obligations that nobody knows how to meet. We've got climate-related disasters increasing in frequency and severity, causing insurance companies to pull out of entire states and leaving millions of homeowners exposed to catastrophic losses. The personal savings rate in America has plummeted compared to historical averages. People are living paycheck to paycheck at income levels that once would have been considered solidly middle class. The American dream of home ownership has become a distant fantasy for an entire generation buried under student loan debt and facing housing prices that require dual six-figure incomes in many markets. When the economic engine starts sputtering, these are the people who have absolutely no cushion to fall back on, and there are tens of millions of them. In 2008, the pain was widespread, but the recovery, while slow, eventually came. The question for 2026 is whether we have the tools, the political will, and the economic flexibility to mount a similar recovery when we've already exhausted so many of our conventional options. Central banks around the world printed trillions of dollars to fight the 2008 crisis, and then printed trillions more during the pandemic. That money didn't just disappear into thin air. It's floating around in asset bubbles and cryptocurrency markets and meme stocks and in real estate prices that have completely disconnected from underlying economic fundamentals. We created a monster of liquidity, and now we're trying to tame it with interest rate increases that are crushing borrowers while barely making a dent in inflation. It's like trying to put out a forest fire with a water pistol while simultaneously pouring gasoline on the edges. The interconnectedness of global finance means that a crisis starting anywhere can cascade everywhere within minutes. We saw this with the European debt crisis, we saw it with emerging market currency collapses, and we're seeing it right now with stress in the Chinese property sector rippling through commodities markets and affecting economies on the other side of the planet. In 2008, the world was globalized, but in 2026, it's hyperconnected in ways that create systemic risks we're only beginning to understand. Your retirement account doesn't just depend on what happens in New York anymore. It depends on policy decisions in Beijing, debt levels in Europe, and political stability in regions most people can't find on a map. So is 2026 better than 2008? The brutal truth is that we're more leveraged, more exposed, more fragile, and less equipped to handle a major shock than we were 18 years ago. We've taken all the lessons from that crisis and somehow managed to set ourselves up for something potentially worse. The tools that central banks use to rescue the economy, like slashing interest rates to zero and buying up assets, have already been deployed and can't be used with the same effectiveness again. The political divisions that exist now make coordinated fiscal responses much more difficult than they were back then. The social safety net has been stretched thin by years of austerity in some countries and political gridlock in others. But here's what you need to understand. Recognizing the danger is the first step to protecting yourself. The people who saw 2008 coming and prepared accordingly didn't just survive, they thrived. They bought assets when everyone else was panicking. They positioned themselves to take advantage of opportunities that only appear during maximum fear and uncertainty. History doesn't repeat itself exactly, but it definitely rhymes. And right now we're hearing a very familiar melody building toward a crescendo that could reshape the economic landscape for the next generation. The question isn't whether something is coming. The question is whether you'll be ready when it arrives, and whether you will look back at this moment and wish you'd paid more attention to the warning signs that were hiding in plain sight all along.